Hey guys, Chris Clothier here with another episode of the Grind Podcast. Thank you so much for joining me again today. We drop these every Friday. I have kicked Kent Sr. and the rest of the crew out. They took over for me 1 week, and I heard it was a complete amazing show. We'll wait to get the numbers in and see if we picked up more listeners after thinking that Kent Sr. was going to take over the show. Do you think that would require me to give the mic up more often, Isabella, if Kent Sr. got more listens than me? All right. So, look, everybody that joined us last week for Kent Sr.'s takeover of the Grind Podcast, thank you so very much. I was able to get out of here for a few days with my kids, celebrating a little bit of the spring break that we all get whenever you got, more kids than you can count in school and running around and doing all their fun stuff. So, anyway, we're back in the office, ready to rock and roll again this week. And I wanted to talk about something that I actually have been thinking about now for a couple of weeks that we really need to be tackling, which was this really rapidly changing environment out there for us as real estate investors, especially. Really, I'm going to focus a lot today on real estate, but of course, as we always know, it dovetails with being an entrepreneur, being in business, because this is just a strange environment to be in right now. And I'm going to talk a little bit about mindset. I'm going to talk a little bit about, daily approach to how we go about doing our business and how we go about how we should be thinking about especially our real estate investments. If you're in an active environment right now where you need to invest, you're looking to invest, you're trying to build out your portfolio, even if you're just trying to get started, if you're trying to change over and buy some different categories of real estate, which we're in the middle of doing some of that right now, there's definitely some ways we need to be thinking about things right now. And I figured I'd share with you where we're at and what our take is. So, if you're joining me right now, I'm quite sure that you're aware that it feels like everything has changed from, 2 very short years ago. Right at the beginning of COVID, we were, inflation was under control. You had, employment was under control. Job creation was strong. Wage growth was strong. We were 6 months away from an election that would get bruising, and we're not going to go into politics here today. It would be an ugly 6 months leading up to that election, and probably even uglier, a few months following it. But just the same, we were sitting pretty. And then all of a sudden COVID hits, and it has really kind of thrown the world for a big loop, because once it hits, it set off this domino effect that, as we sit here today, I'm not sure, what the day it is that you're listening to this, but we're sitting here right now and it's almost like we're waiting for what's the next domino that's going to fall. So we have COVID, we have this weird dynamic where there's these massive supply chain issues, but while all these supply chain issues are occurring, you also have, due to restrictions on travel, due to the inability to be able to leave the country in many cases, due to so many people being locked up in their houses for so long and their need to be starting getting out, for so many people that started working from home, suddenly the housing market got really, really hot at a time when there wasn't a whole lot of new building going on. You continue to have new home formation. So you've got people that are looking for new houses. They're looking to buy their first house. Many are choosing to have to rent instead, which means rents are going up during a time when there was a lot of fear because people were losing jobs and wages suddenly weren't growing anymore after COVID comes in. So, I'm kind of rehashing here that we just had this really weird dynamic of, it seemed like everything was the opposite of what was supposed to be occurring. We come into this year, I know there's a lot of optimism that suddenly that the housing market has remained strong. There's super high demand. We haven't made it through the supply chain issues, but we're on the other side of the consumption side of it. In other words, meaning, the supply chain issues were more restrained to the luxury goods, the luxury side of it. A lot of things have been fixed with as far as new builds and housing were concerned, and the ability to be able to get things out of the ground and completed. For all intents and purposes, we had really kind of already solved many of those supply chain issues. It was more on the other side, renovating things or buying, furniture and other pieces for our houses and stuff. These ancillary things that we're still dealing with the supply chain. So, as far as housing is concerned, we're looking at it saying it's actually super strong. Demand's through the roof. The interest rates remain at historic lows. And then all of a sudden, there's talk of inflation. We're starting to see that there's real inflation. It's not transitory. It's not something that's going to be, coming and going. It's here and it's going to stay. And the fear of rate hikes comes in. As soon as the fear of rate hikes comes in, mortgage rates bump up a bit. Suddenly there's fear in the marketplace. More and more people are saying, I'm going to hold back. I'm going to sit back. I'm not going to get started. And we see this, I don't know if you guys are seeing it in all of your markets. I know we're seeing it in every single market we're in, of this rush in of institutional money. So institutional, a lot of people want to say it's New York money. I don't know necessarily that's the case. It's wherever the institutions are. They're all over the country right now. You've got whether it's family offices or hedge funds or funds set up specifically for just investing in real estate, whatever. You got it all over the boards. Just started buying, real estate like crazy. Didn't matter the pricing in many cases. They would pay top dollar. They just wanted to get as many assets under control as possible. This was kind of a clue to us as investors that, hey, we need to be careful right now and really figure out the market we're in. Do the hedge funds know more than we do? Do they know something that we don't know? Are we missing out by sitting on the sideline? And my conclusion was yes. Anybody sitting on the sidelines right now was missing out on an opportunity. And it wasn't an opportunity to buy, necessarily to buy real estate. It was an opportunity to be able to borrow 30-year money at rates that were still historically low in an environment where you knew without a doubt that they would be higher in the future. It's kind of funny. Nobody's got a crystal ball. Nobody can tell you exactly what's going to happen. But I've got an acquaintance of mine who I happen to respect a lot named Jay Scott, who pointed out to me, this was almost a year ago, that for the past 12 to 24 months, and even right now today, as you're listening to this podcast, one of the most valuable parts of the equation in investing in real estate today is the 30-year fixed mortgage. This is, of course, if you're buying these single-family homes. The fact that you can borrow 30-year money at what remains historic low interest rates makes the loan itself more valuable often than the house. Now, of course, the house right now, we're seeing continued inflationary pressure pushing the cost of housing up. But if you can borrow 30-year money in an environment where that the Fed is talking about raising rates, bond sales have slowed down, suddenly we know mortgage rates are going to be going up in the future. There's a prediction they'll be up to a point higher, 12 to 18 months from now. So where we've been buying at historically low rates in the 2s and 3s, we're going to be buying in the upper 5s and low 6s 12 to 18 months from now. And we're going to continue to invest because that's going to be historically low when you start looking back through the decades. When you're buying investment property, to be below 7%, there have been a few periods since the 80s where you've been able to do that, for extended periods of time, but not a lot. And, we've gotten kind of, used to it over the last decade, these really, really low rates. Well, they're going to go up. And so as we look around today, we kind of know that interest rates are definitely going to go higher. So we need to be locking up whatever assets we can today at these historically low rates. Anybody that knows me knows that I hate 30-year money. I don't like holding real estate with leverage. I like paying it off. But if I can still borrow, because 30-year rate money tends to be super inexpensive and it's got the highest amount of flexibility. If I can pay it off early, sure, I'm going to pay it off early. But that may not be the right option for every investor out there. So look, if you're wondering with what's happening in the world today, with what's going on with the interest rates, should I be buying real estate and buying assets? Yes. Yes. When you can borrow 30-year money at these low rates, you need to be doing it. And look, when we kind of continue to roll through what's happened over the past couple of years, and we realize that, you've got Europe and the U.S. in a bit of a Cold War right now with Russia. You've got a real war going on in the Ukraine with between Russia and Ukraine. I mean, you've got a lot of fear out there and a lot of reasons to really be forward thinking that there's going to be more pressure on everything that we do in our daily lives, food supplies, pressure on consumer goods, pressure on many of the items it takes to build and complete construction through homes and stuff. So the supply chain in general is going to go under even more pressure because of this war. And it's one of those things that generally lags. So you're talking 90 days to 180 days after, this war starts. So you're talking by the summertime, we're going to feel some real pressure. That pressure is going to mean that those that have the ability to put down payments, 25% down on assets, and acquire these hard assets, they are really shielding themselves from the future inflationary pressure that's coming. We can look out and say that, man, there's just been one domino after another from COVID to now to all the way to the war. I mean, you just see these dominoes falling. It's making it harder and harder and harder, so that those that should, because I can promise you there's one thing that we know is going to happen. Demand for housing is not going to go down. We have not met basic consumption over the last decade. There are so many families out there today that are renting homes that want to own. Now, many of them will wait. They'll wait till the right moment. They'll wait till the right time, which, each of them will decide when that is. But I'm looking at, I don't know, I think you have to take this in chunks. 5 to 7, maybe 10 years from now, we will have gone through a kind of a resetting cycle. It'll be something to the effect of rates will drive demand down, which will drop pricing on some level, and then rates will begin to improve. Our supply chain will catch up. Our ability to build more houses than what we're building today will catch up. We'll have extra inventory. That inventory, along with lower rates or better rates, a better environment for people to be moving in, will absolutely spur demand, and that demand will start a whole new cycle. And so those that are buying right now, that have the ability to buy right now, I don't see any major adjustment. I don't see any major change in pricing. We'll see some corrections in some markets for sure, but I definitely see the opportunity over the next, again, and this is a long period of time, but 5, 7, 10 years, which is a normal hold for an investment, especially a piece of investment property like a single family home. I do see prices going up. I do see prices going higher. I do see that rents will remain stable, strong, and growing in some markets. They may level off in others, but just the same. You have the opportunity to be able to borrow money at rates you cannot borrow at in the future. We know that. We can see that coming. So if you're on the fence out there today about real estate, wondering like, man, there's just so much going on in the geopolitical atmosphere. You've got, all these unknowns and so much fear. My answer would be that you do good due diligence. You're cautious. You make sure that don't spend every last penny you have to buy real estate. But if real estate was something you wanted to build and your goal was to build a portfolio and you have the funds to do it, this is still an excellent time to buy. And there's still excellent markets across the country. There's opportunities everywhere. And I would certainly not let the interest rate be the factor that keeps me from getting involved, because interest rates aren't coming down anytime soon, not by what we can see. And I'm not expecting them to double, nothing crazy like that. But I don't, I think we went through a really, really great interest rate period, and we're still in it. We are, but we can now see the kind of the end of those great rates. We know that they're going to come to an end at some point. So, man, throat's getting dry. Excuse me. I appreciate you guys sticking with me today. Today's show all about what's coming up, what we should be doing as investors if we're looking to get involved with today's kind of strange atmosphere. But I'm telling you that right now I'm a buyer. I remain a buyer. I'm looking for commercial deals, and I continue to buy residential real estate because my portfolio is not completed. I want to continue to build out my portfolio. As long as that's the case, I'm going to continue to look for the deals that I like at the rates I like. So if you're like me and you want to build your portfolio, I do believe now is as good a time as it has been. And it's certainly a better time today than it will be a few months from now in the future. So with that, I appreciate everybody joining me today. Thank you for sticking it out with me. I'm going to grab me some water here. And guys, I hope everybody's doing well, taking care of each other. Until we meet again, commit to the grind. We'll talk to you soon. Thanks, guys.